need to talk about the Federal Reserve massively cutting interest rates in the face of inflation plummeting, despite the last projections we got from the Fed. And along with that, not only are we going to look at the data along as what some former Fed economists think, but we're also going to look at investor positioning. Where is it potentially least crowded in terms of positioning right now? Let's talk about all of that. Hey everyone, Meet Kevin here. Remember, the only sponsor for this channel is me. So check out the programs on building your wealth linked down below, and shadow me for a day if you'd like by checking out on the shadow Kevin for a day and join him on his private jet as he goes explores real estate. Remember, I'm a licensed financial advisor, but this is not a personal financial advice video. It's an economic update on cuts from the Fed. And if you want to learn more and join me in private live streams and ask questions directly, check out the links down below. Okay, let's jump into this. So here is a former Federal Reserve economist, John Roberts. We're going to start with what he says about this surprising December summary of economic projections. And then we're going to lead into how does this potentially affect rate cuts coming from the Federal Reserve. Now, it's also worth noting that guess who shared this particular piece on monetary policy? It was none other than Nick T. Now, Nick T is actually really important when it comes to where things are coming from, because Nick T, this guy over here on Twitter, is the kind of guy who's been known to be the Federal Reserve's mouthpiece. So if he says something, there's a chance it actually came from the Federal Reserve. And what's fascinating about this is that John Roberts starts by saying, holy smokes, we had a Fed here that went aggressive. They thought that in 2023, based on the last summary of economic projections, we're going to be knocking on the door of a recession, a much lower GDP estimate than anyone was expecting. We have a higher inflation estimate than anyone was expecting, PCE at 3.1%, which you're going to see some data in just a moment that suggests this is way high compared to what we actually think we're going to get. And a Fed funds rate capping out at 5.1%, also much higher than the September projection and higher than anybody thought. So you had a pretty aggressive Fed report here. John Roberts thought that this was really surprising, that the Fed has this heightened pessimism around inflation, which doesn't really make much sense because the incoming data for inflation hasn't really been that bad. In September, we saw core prices rise 0.6%, which isn't great, but in October, November, we saw them only rise an average of 0.25%. So why is the Fed being so aggressive? Well, many think there are two explanations for this. One explanation is the Fed basically just wants to keep this stone cold hard face on, and they're basically saying, hey, look, inflation coming down, that's what we expect. We're going to keep hiking. And basically, they're trying to push the markets to overcorrect to the downside to make sure that inflation doesn't pop up like a golfer at whack-a-mole. Or I guess that's like a mole pop in their head. But anyway, you get the idea. They don't want it to pop up again. They want to keep it down, and they'd rather push harder than they need to make sure there's no chance of it coming up again. And that over-pushing could really push us into a recession. Now, there is the potential argument that, well, maybe they're worried about wages, right? That third piece of the inflationary puzzle, that wages are too stubborn, that over the 3 months through November, average hourly earnings rose at 5.8% at an annualized rate, up from 4.8% in the preceding 3 months. That's a problem. But when we actually dig into the labor reports, as we've done many times already on this channel, what's a quick summary of what we find? Well, we see that labor force participation is up, a sign that people are running out of their stimulus check money and credit card spending is so high that they need to go out and basically get another job. This is why we're seeing more multi-jobbers and more part-time workers boosting the unemployment numbers. We're actually seeing lower real job gains. When you look at the Philly Fed tells us, yeah, we didn't create 1 million jobs in the second quarter of 2022. Maybe we created 10,000 new jobs. In other words, the actual number of job gains is being way overstated. And in our last report, we actually saw wage gains get revised down at the same time as average hours worked per week is coming down, which would actually put upward pressure on the data, really suggesting that wages are actually starting to flip-flop. But the problem is, if wages do end up flip-flopping, look what you get here. And you actually get unemployment rising, you do increase the risk of a recession, which the increased risk of recession increases the odds of big cuts, which we're gonna talk about big time in just a moment. But look at this. This is actually a really interesting comment here from the article Nick T shared. They suggest here that, wait a minute, we have never seen the unemployment rate rise by more than 0.5% outside of a recession. Now that's actually really interesting because what you have is the projection that the unemployment rate is actually going to rise by somewhere around 1%. If that actually happens, then we're probably looking at a recession, which is likely going to be followed by massive rate cuts, which is exactly what the market is starting to price in right now, especially if it's true that peak inflation is behind us. Now, what's fascinating is what the market is starting to price in. According to VandaTrack, in this email I received this morning, investors are no longer focused on the terminal rate. Instead, they're focused on the coupon code linked down below for the programs on building your wealth and making more money, like in the Elite Hustlers course, the new course showing you all the tax benefits and tricks I know for building your wealth, or people wanting access to those fundamental investing live streams where I break down earnings reports, cash flow statements, balance sheets with you, and we do it all together and I answer your questions. Check those out, link down below, get lifetime access. Though actually investors are no longer focused on the terminal rate, that is the height of where the Federal Reserve is going to hike rates to. Instead, actually the market is now focused on bets suggesting the Federal Reserve is going to cut by almost 2 percentage points by the end of 2023. Now, I want to be very, very clear here. I think there is a massive difference between the Federal Reserve pivoting and the Federal Reserve U-turning. Generally, the Federal Reserve pivoting is sort of deemed to be a reduction in interest rates, interest rate hikes, kind of like going from 0.75 to 0.5. That didn't lead to a market bottom, right? Things got worse after that. That's expected, though. I also don't think a pivot is going to zero or a pause, right? I really don't think that's really the pivot. I think a big U-turn is when the market really hits bottom. And that U-turn seems like it's starting to get priced in now, because historically, the U-turn is when the Fed goes, oh crap, we went too far, turn everything on its head. We're not just pausing, we are stimulating again. Print money again, cut rates again, and the market is now trying to pre-price in the U-turn. I think that's why we're in sort of a rally mode today, at least in the stock market, which could be a bear market rally, but I do believe markets are going to pre-price in this Fed U-turn because it's been so historically clear, starting in the late 80s, followed by the 2003 Fed U-turn, which marked the stock market bottom, the 2009 February bottom, which marked the bottom of the market when the Fed U-turn, the December 2018, the March of 2020, right? All of those were Fed U-turns when the market bottomed. And the market is trying to pre-price that in by saying, look, we are going to get almost 2 percentage points, 1.77 percentage points worth of cuts by when? The end of 2023. But wait, the Fed says they're not even considering cuts. Exactly, because they got to tell you to your face they're not considering cuts to try to keep that mole of inflation down. But the reality is when poopy hits the fan and inflation actually does plummet, they're going to have to cut. And we're going to be right back to the days of money printing. That's almost a 2 percentage point decline. Now, I want to remind you of a video that I made a month ago where I started talking about this. A month ago. This is that video a month ago. It's the title is The Coming Massive Fed Bailout, Prepare to Go to Zero. And what did I talk about here? I talked about the yield curve inversion of the 10s, 2s, suggesting that we're actually going to see about 500 basis points of cuts by the time the cycle ends. Basically, what they do is they look at the depth of the inversion on the left side here, and then they correlate that to what has historically happened when the yield curve has inverted. And when you align these two, you set up for about 500 basis points of hikes, because you could see we had less of an inversion in 2020, we had less cuts. We had a larger inversion in the 80s, and we had substantially more cuts, 800 to 900 basis points, 8 to 9%. Well, here we align at about 500 basis points of cuts. But wait a minute, The highest that right now the Federal Reserve actually thinks rates are going to go is sitting at what? Oh, 5.1%, which written another way is 510 basis points, which if you actually get the full reduction of 500 basis points, you're basically at 0 to 0.25 again. That's 0% of a rate, which means if we get 1.77 or about, let's just call it 200 of that now, we go from maybe a peak of around 5%, 500 basis points, take off 200 in 2023, we could see another potentially 200 come off in 2024, and maybe that last 100 come off in 2025, or it could all go a lot sooner as the Fed freaks out even more. Now, that's pretty wild, but again, the market right now is starting to price in cuts. Now, this actually does create a downside risk. What's the downside risk? Well, the downside risk is simple. If inflation, or let me put it this way, if the inflationary mole pokes up again, what happens? Boom, down, right? Because if the inflationary mole pokes its head up again, the market's gonna go, okay, yeah, we're getting a little bit too premature here. We're not going to end up seeing those cuts. Let's go ahead and revise down our expectations for cuts, and then we actually see the market fall more. Again, if we think that the markets or that inflation is going to plummet, kind of like VandaTrack here thinks it does, oh boy, then we're good. As long as we don't see another peak, right? Markets upturn could actually be sustainable. This is VandaTrack's implied headline CPI projection right here. This here is VandaTrack suggesting that inflation is currently sitting around 7.1%, and that the market is expecting that by July and June, we're already going to be sitting around that 2% number. Which, remember, folks, everybody gets this wrong online. Everyone gets this wrong online. Everybody forgets what the Fed's policy actually is. Everybody online is like, but Kevin, 2.4% isn't 2%. Everybody thinks the Fed needs to get this to 2%. And that's exactly what the Fed is saying. Hey, we're going to get rates to 2%. But what everybody forgets is fate. Yes, flexible average inflation targeting. Fate. As long as they average 2% using the last decade and the next decade, we could be Gucci with 2.4% for a little bit as long as it continues to trend towards 2%. And that then sets us up for analyzing positioning. Crowded trades versus non-crowded trades. What has pricing power? What doesn't have pricing power? When do you get into real estate? Obviously, you know, I've got a real estate startup. We're raising a lot of money. We've raised over $20 million for HouseHack. $20 million cash sitting in the bankola, ready to go buy real estate with my real estate startup. We're mostly at a 1-to-1 valuation right now, so if you're an accredited investor, check it out by going to househack.com. If you're not accredited, we are releasing our full SEC audit and as soon as the SEC clears it, and we'll be releasing everything for the non-accredited around very soon, hopefully by February or March, so we'll see. We're very excited about that. So what do we have over here? Look at this. This, folks, is interesting. This is thematic positioning. Right now, thematic positioning is overweight stagflation. So in other words, if markets right now are suggesting, oh no, we're going into a stagflationary environment. These are crowded themes. The higher we are on this chart, the more crowded the theme. The less crowded themes right now are actually recession themes, your safe havens. This could be like a gold trade, right? And your Goldilocks trade, or even reflation trades. Reflation, this is actually expecting sort of like market reopening. This is what we thought was the big reflation trade of the summer of 2020. So I would probably venture to say the biggest trades right now probably should be not really stagflation. We don't see indicators of that unless that mole pops its head up, but probably recession or Goldilocks. One of these is going to push. Duration would be like growth, right? Purchasing power stocks, companies with really strong long-term fundamentals that are unfortunately unpopular and anti-traded in times of stagflationary fears, right? But in my opinion, pricing power stocks really take off and in a deflationary time or disinflationary time, and they are not very crowded at all right now, which in my opinion creates an opportunity, especially if you could find a pricing power related or an ETF that has a lot of pricing power stocks, specifically because in the event certain stocks within that basket run, actively managed ETFs have really unique tax benefits where they can exchange stocks, kind of like a real estate 1031 exchange, without passing along capital gains to the investor. Haven't you ever been frustrated that like one of your stocks has performed well and the others not so much maybe, and you want to rebalance, but then you don't want to pay those capital gains and you end up with a lopsided portfolio? That's bad. You could fix that with actively managed ETFs. It's the biggest tax loophole I've ever seen in stocks. Talk to your CPA about it, obviously. I'm not your tax consultant. But anyway, this is fascinating because when we put these pieces of the puzzle together, as long as that inflationary mole doesn't rear its head again, and as long as the Fed keeps having that hard face on inflation, keeping inflation expectations down, actually helping inflation fall, then when inflation plummets like VandaTrack expects it will by this summer, oh boy, we could start really actually seeing the Federal Reserve start implementing their U-turn, and we could start seeing cutsolas, unless of course the mole of inflation peeks its head. So this is very optimistic, this is very bullish, but you have to be cautious because again, we've played this game before. In March, we thought inflation was down in 2022. What happened? It peaked its head again. We thought the same thing in the summer. What happened? Inflation pops back up. So you have to be careful. Oh, and look what just came in. New York Fed, 1 year inflation expectations fall to 5% versus 5.2%. That's a year out. 3-year inflation expectations unchanged at 3%. Good. Another optimistic inflation report. Let's keep it going that direction. Things could be good. Thanks so much for watching. We'll see you in the next one. Goodbye.